Yeah,
If you like the panel, don't say like, wow, this is good. Yeah, just
I'm about to shoot there. No, this is it's much fun. So I'm going to sit here for so yeah.
it's very, very volatile.
About to, sorry, but
No, a gentleman would say, go ahead. I give you.
actually there's a space with the sofa there, but
Hi, darlings.
oh, sorry.
All right, good evening, everybody. Thanks, Chuck. All right, good evening, everybody. I think it's time for us to kick off the evening of some money talk and to be more exact of some no-nos of fundraising. Really good to see you all here. So tonight's event is actually a collaboration between Cocoon Capital and Slush Singapore. You can guess which one I'm representing tonight. So my name is Anna Ratala. I'm the head of Slush Singapore here. We have some other members from our team as well present. And this is actually not the first time when Cocoon Capital and Slush are collaborating. So we're hosting a startup masterclass a few weeks ago where Michael was actually sharing some of his insights, and we decided like, hey, we work together pretty well, so why don't we do something fun together again, and thus this evening for you today. Before I give the floor to our hostess and the panelists today, I wanted to make a quick announcement from the Slush side. But before I do that, I just wanted to do like a really quick question of who knows about Slush? Who knows what Slush is? Wow, that's really nice. Great. Very good. It's always very encouraging to see every time we have an event that more and more people know about what we are. But for those who don't, we are the world's best tech startup event.
Yeah.
Yes.
Yeah.
Okay, so it turns out I'm not even biased, right? So, but really, the reason why I think we are the world's best is because we are really more than an event. We're a global movement of young entrepreneurs and out-of-the-box thinkers that come together and once a year throw a massive tech festival where investors, startups, the media, the corporates come together, talk about the future of tech, talk about entrepreneurship, talk about success, talk about failures. And the reason why we're doing that is not to run another tech event, right? But we actually want to change the mindset towards entrepreneurship. We want to make sure that more and more young people go and start up businesses, maybe some older people go and start up businesses, and they would not have to constantly explain themselves to family or friends or people around them, right? Because the entrepreneurs are really the future of the economies, whether it's here in Singapore or elsewhere in the world. And to the announcement, so last year we actually organized the first Slush Singapore in the history, and encouraged by the very positive feedback, we're doing it again this year, and the date for the Slush Singapore 2017 is actually 19th of September. So 19th of September, you can save the date. We haven't launched it officially yet, so you guys are one of the first ones to hear about it. Looking forward to seeing you all there. If you guys want or are interested in the event or any other updates before that, ping me during the networking session. We'll be happy to add you guys on our mailing list to give you some updates. Also, we do have our next startup masterclass next Friday, 12th of May. So if you're interested, it's about leadership and recruitment. We're going to have some speakers from Google and Rotary Urban to share some insights. So if you're a startup founder, you want to join, let us know. We'll send you the invitation. But this is not what you're here for. You're actually here to hear from our great panelists. So I will hand over to our hostess for tonight, Modita from Cocoon Capital.
Very good. Thank you so much. So welcome everyone tonight to our event. Can you hear me? Yes. Okay, perfect. So before we start, let me just a quick show of hands. Who are the founders here? Okay. And how many of you are fundraising at the moment? Okay. I see more hands showing up for fundraising than earlier. That's a bit strange.
That never makes sense.
That's a bit strange. So tell me, how many of you did research on Cocoon Capital before you arrived today? Honest. Okay, it's just like that, 5 hands show up. That's not very encouraging, is it? Okay? So now let me introduce to you our panelists today. We've got Michael Blakey, who is a managing partner for Cocoon Capital. Cocoon Capital is a 10 million fund seed stage venture firm focusing on early stage digital companies across Southeast Asia and India. He's a veteran investor, was named the UK Angel Investor of the Year in 2015, and was selected as one of the Maserati 100 and classified as the business angel you should know, right? And next we have Grace Tsai, who's the CEO and co-founder of the Hub Singapore. She's also partner and investment committee for the Hub Ventures Fund, which invests in early stage tech startups across Southeast Asia. The typical investment for the Hub Ventures Fund is at pre-seed and seed stage with a ticket size of up to $500,000 Singapore dollars. Now she's been on both sides of the table. She's raised funds and now she's investing in startups. And last but not least, we've got Terence Sim, who's an associate director from Vickers Ventures Partners. He works closely with the investment committee and focuses on advising Vickers portfolio companies and their business strategies, including helping them with subsequent fundraising rounds and exit opportunities. Now, thank you all for being here tonight. So let's start with something positive to kick off our panel. So perhaps if you can, each one of you can share with us 1 or 2 companies that you've picked, that you know, and why you decided to invest in them in the first place. You know, what are you looking for, and why do you see them as a big yes to invest? Any one of you have a microphone there?
Hello, this is on? Yeah. So I think the most recent investment that we made, literally within I think about 40 seconds, I made the decision that I wanted to actually invest in them. The guys walked into the room, and within 30 seconds, I knew exactly what the problem was that they were looking to solve, and the size of the market opportunity, and why they were the right people to actually do it. They then spent the next, I think, 30 minutes demonstrating to me that they're very detailed. They had actually looked at our website beforehand, and they actually knew a couple of the companies, and they'd actually already gone ahead and actually done a reference check on me to make sure I was actually somebody that was worth them talking to. So for me, that's that they came in prepared, and they had actually personalized the pitch to me, knowing what I would like, knowing that it was in a space that I was interested in, and making it relevant to me. A lot of the times, a lot of people, when they come and pitch, it's just a generic pitch, which they would probably give the same pitch to all three members here, and to be quite honest, investors like to feel special as well.
So with that feeling, if you can share with us, how long did it take you from that first meeting to the term sheet?
It took us 2 and a bit months.
Okay.
And then to close off from term sheet to the money in the bank took a further 6 weeks. And mainly, we could have actually done the term sheet a lot faster, but I actually wanted a chance to actually work with the founders before I actually made, my gut reaction is normally pretty good.
So about 4 months.
Yeah, I've worked hard on my gut, but I've always got to double check. And a lot of the times people just assume that they can come, they're going to ask for the money, and the money's going to be on the table. I want to get a chance to actually know. I'm investing in people. Everything that I've been shown is a bit of fantasy. They're kind of a lot of assumptions. So I think on that case, sometimes you'll find investors, and probably others will say the same, we actually delay the process a little bit so we can actually spend more time with you. Okay, I might hand over now, otherwise I talk all night.
It's okay, you can talk all night here. So maybe I'll just share more generally, because as Monsida said, I am first and foremost a founder. And a founder who has built an ecosystem and an environment that supports other entrepreneurs, right? They help with maybe around 1,200 alumni and current members right now, and they have raised $250 million under our members when they're working out of the hub, right? So the pattern recognition has already been established way before I was an investor, and so we thought that we could use that to into venture as well. So some of the characteristics of a deal where, like Michael, in 30 seconds I would go like, yes, I'm seduced by you. I want to get to know you better, and for real, get to know you as a person better. And some of these feelings arise from a few things. I think, first of all, it's really, we're looking for an insight. We're looking for an insight that the entrepreneurs have that is unique, that is real, and that is fundamentally quite exciting. An insight that we haven't heard before, even if it's overlaid on an industry that we know very well. Do you know what I mean? The insight comes from two ways, right? One is, if they are already an industry veteran, right? We love people who are around 40 years old, for example, who have been in corporate for 15, 20 years, know every problem, every crack in the industry, has the networks, and the first few customers to kind of start a company with. We love those type. We give a premium for those type of people, and the insights they have is substantial, right? A second kind of source of insight is maybe by the younger bunch who have personally experienced a certain pain in their lives, and now they want to solve that, right? So as you can already see, I'm much more around the person, around the purpose, around the pain that they really, really want to dedicate their lives to solve. Because for the investor and the startup and the entrepreneur, it's going to be a 10-year relationship, right? Some would even argue that that's longer than a typical marriage, right? Oh, sorry, I'm not married yet, so I don't know how long marriages should last, but these days. But
That's another panel now.
Yeah, that's another panel. But it's not very different, right? That chemistry, that compatibility, and that knowledge that you want to spend 10 years with this founder. It's a long relationship. So all these elements are what I'm looking for.
Okay. Terence?
Just to add on to that, I beg to differ. I think sometimes 1 in 10 years, because if you look at most of the successful VCs, right, they reinvest and invest and reinvest in the same person again. The person to make an exit. We already did so far, I think 2-3 orders in Singapore. No, 1 in China, actually it's 1 in Singapore and 1 in China, right? So they exited. They started a new company, we invested in them again, and these guys typically when they're second time entrepreneur, they will actually create one of those fastest growing companies, right? I mean they can raise money much easier, they can show much better traction, they gain the investors' trust. All of these are characteristics that we like to look for. So I like to agree with Michael. Sometimes when the founder walks in, you know that you're going to invest in this guy, okay? Or at least when he tells you the problem statement and trying to solve, you recognize that this is a real problem. They are not trying to reinvent. They are not trying to just reinvent the wheel, which I think many startups these days in Southeast Asia are doing something like that, trying to reinvent the wheel.
Do Vickers invest in seed stage or later stage?
We
I know you're looking funds.
Yes, we are already into our fifth fund.
Yeah.
So we typically do Series A/B. I think our minimum check size is about 1 to 5 million. On average, we do a 3 to 4 million check size first investor.
And did you just close your fifth fund?
No, we are still in the midst of closing. We already had the first closing. We raised I think 90 million US, and then we are.
Guys, take note. They have money. Haven't deployed yet.
No, so we have been deploying over the past year or so.
Right.
So as we raise funds, we deploy. So I like to tell most startups that despite being a VC, I have experience in fundraising as well. Because before we can invest in you guys, we need to raise funds as well. So I have the same pain points during presentation. Where do I pluck up some numbers from, right? How to do all this market research. So I understand this is a tough process. And more often than not, right, even when we do pitching to raise funds, sometimes we have to structure our pitch accordingly. So we can't use the same PowerPoint presentation to the same bunch of guys.
So basically, know your audience. Who
you need to know your audience for
you're
sure.
pitching to, right?
Correct. Otherwise, you tend to lose focus, right? I have guys that try to pitch to me. I was just, I like the space. I wanted to know what he was doing. So he reached out to me and said, okay, let's meet up.
Right.
After he pitched for a long while, he says, actually, this is just an idea. I'm raising seed money. And he actually reached out to me without first trying to know that what are we doing, what check size we are writing.
Yeah.
So I think this is something that's very important, because after a while, if you think about it, right, you waste an hour of each other's time and you end up with no clear result. Sure, more often than not, you need to know the VC way in advance, but at that point, it was quite clear that this guy was just best making everybody and trying to see who he can get the appointment with.
So what would you say, what are the key things you're looking for in a founder? Other than, what you've mentioned so far has been this chemistry, the vibe, the energy. Can you be a bit more specific? I know this is a bold question, so.
I think it's quite, it's quite difficult to be specific, right? Because really some guys just know this X factor, and really to me, it's not only about purely the founder. As VCs, we always like to talk, it's just the team, right? Yeah. It's not necessarily so, because these founders must be the guys that be able to solve a real problem, right? Trying to reinvent.
Are you against sole founder?
Sorry?
Are you against investing in a company that's only one founder?
No, I don't think so. We've invested in sole founders, we invested in teams, but okay. So our experience is that we typically invest in teams, maybe with 2 or maybe 3 co-founders. We haven't seen teams with 5 co-founders, and then we try to make an investment in them, because more often than not, we have expressed an interest, but even though we eventually didn't pull the trigger, but we saw their progression over time. Typically, 1 or 2 guys will actually drop out. So that creates a problem with the cap table and so on and so forth. But generally, we believe in a strong founder will find the right guys to hire.
Cool. Grace?
So we look for 3 concrete things. The first one is the problem, right? it's very clear after a few minutes of conversation whether a founder really understands the depth and the seriousness of a problem. So that's one. And versus someone who just understands and speaks of it superficially. Okay, superficial chit-chat around a problem is very different from a very, very deep understanding of one. The second one we're looking for is the ability to be hyper-focused on execution, right? Having just a dream and not a relentless ability to execute should be left a hobby of some kind, right? And not to put other people's money at risk. So that relentless, hyper-focused execution has to be evident as well. And the third one is very much the attitude of coachability. And again, this is very important because for us, we're looking at very high-risk, early-stage pre-seed seed rounds, right? We are the first professional investor to come in after your own money or your family or your friend's money, right? So at that point in time, anything can change. Your product can change, your market can change, your problem definition can change, but what doesn't change is the person. And if the person doesn't know how to listen, is not coachable, cannot pivot, cannot be whatever, then we're screwed, right? Because everything changes in 1 year's time, except for the person. We always say we want to change, but actually we can't, right? So it's really that coachability that we're looking for.
I think I agree with everything that's been said, but I'll take it to a slightly different approach. As I said, I like when fundraising, it's very rare that I'm ever going to say, first meeting, yeah, I'm going to put a check in you, and then a few weeks later I give you the money. One of the reasons I actually want to delay it is so I can get to know you and actually how you deal with different situations. So it's very easy to fake one meeting and then say, yes, you're wonderful, we really want to work with you. But quite a few examples of how I look at in terms of how you actually approach fundraising, to actually how you run your business and how you actually do sales. For example, I received so many emails I had one quite a few months ago, which it said, hey, dude. And I was like, yeah, I didn't say what I wanted to say something back to him, like, but, or it's hiya, or hi, and then just blank, and I'm like, well, would you actually approach, is that the way you would approach a customer? Again, it comes down to the personalization. Also, you have this thing, it's like, really urgent that we talk to you, we really want to work with you. And now, I receive about 250 emails a day. I do reply to every single opportunity that comes to me, but it can sometimes take me a few weeks. Now, what's always interesting, I come to an email 3 weeks down the line, and the guy said it's really urgent, he really wants to talk to me. And I look in my inbox, and I'm like, he hasn't sent me a follow-up. Again, is that how you do sales? Like, for me, I like to be hustled. I want to see how, there's very little chance. I mean, I can ask for a reference for you guys. Now, are you ever going to give me anybody who's going to give me a bad reference on you? Probably not. So all I can do is, how do you interact with me? Is it, you send me a gentle reminder, I know you're very busy, Michael, but it's been 72 hours, just wanted to put this back at the top of your email. That kind of shows me, okay, this guy knows what they're doing. And then it goes to the sense of, I ask some really simple questions, do you have your financials? Or what are your assumptions? And they're like, we haven't done them yet. I'm like, well, again, would you go into a meeting unprepared? Or, have you actually looked at my website? Again, do you know who I am, who you're pitching to? And then it goes, when we get past that first stage, and if I'm still interested, I look at it, and, every so often, and part of my language, I act in a meeting like an absolute douchebag. I'm very aggressive, and I'm giving you all the insights here, because I want to actually see how you deal with conflict. Because I'm a supportive investor, and I will work with you a lot post-investment. But there are always going to be times that we disagree. And what I want us to actually see is that even if I'm aggressive, even if I'm very passionate about a point that you disagree with me, how do you actually handle that situation? Do you just sit there and tell me to F off? Do you actually listen and then have a debate with me? Do you kind of say yeah, and then totally ignore everything that I say? You know, and a lot of these times it can be around your financial model. So a lot of times that is not actually one right answer. But for me, it gives me a chance to actually see, can we actually work together? Sorry, she's my boss, so it's like...
I need to keep track of time here. So thank you very much, Michael, for the insights. We have got like 10 questions. I don't think I can have time to run through 10 or 12 of them. Is the air conditioning off? Oh my gosh. Okay, so now quickly just run through. What's the best way that you've ever been approached and pitched to by an entrepreneur? Okay. Brief.
Okay. Very briefly, I got a parcel in the post. I opened it and it was a shoe, one shoe. I was like, I can't remember buying any shoes, but it's bloody daft to send me one shoe. I've got 2 feet. And then I saw a note. I opened the note and it says, "Dear Michael, I know you're a very busy person, but I just wanted to get my foot in the door." Didn't say anything else, but had a telephone number. I called him up immediately, met him the next day.
Very nice. Very nice.
That's special.
That's a good story.
Well, I don't have secret parcels that would be very good. Yeah, usually it will be either from a referral, from someone I trust and someone I know would have vetted that person for me. And also if, we're so public. We have 2 hubs. I'm always there, and my team, and if you rock up and you show that you have read up about us, read up about our philosophy, read up what we stand for, what I believe in, and then, establish that prepared first initiation, that would be good versus, someone who's absolutely clueless about you.
I think so for me it's as well, I think it's referral, right? Because we invest a little bit later stage. So we are pretty sure that, before you have us as investors looking for the next A or B round, you typically have other institutional investors. So it's not easy for me to reject a friend and hey, look at this guy, this guy doing something that's very nice, that fits your portfolio. So if it's a fellow VC or someone that we trust, talking to me, even if I don't like the space, I feel obliged to at least meet the guys rather than sending us the cold email again, depending on what stage you are at, will be a little bit...
So it's better if you get an introduction
yes, I think that's the
rather than cold email.
No, it's cold emails, talking about emails. I have some guys that send me emails, hey dude, it's pretty, I think it's not too bad. So, hey Michael, and then it was sent. And then it was really, you can see from the content of email, it's probably a standard email, copy and paste, and just sending out everyone.
Yeah. So on to you, Terence. What are the common mistake that you find in presentations or your conversations with a startup when the first engagement?
I think at the end of the day, you need, as a startup, you need to see who you get to pay with the right. Are you the right investor? So for us, we have A or B guys. If you tell us, I did some research on your company, and then you invested in this space and all that, and then the first few part of the presentation, the first 10-15 minutes, you tell me of the problem you're trying to solve, the addressable market size, and so on and so forth. In my mind, I'm just thinking, if you really did research on me and you think I really invested in this space, I should know this space. Why go ahead spending 15 minutes of either meetings an hour and a half?
Yeah.
Why spend 15 minutes talking about the market when you can just tell me who you are and why are you so different from my current investments or the investments that we and then some of the potential portfolios that we take.
So get to the point that
Get to the point first, and then when
conversation up front.
Right. When you say you do research on me, I need to see that you actually done research on me. Not asking me, what are the check sites you write. We just did a press release a day before these are the check sites I write, and don't come to me saying that actually I'm only raising a quarter of zero. It's just a bit too early for us.
Yeah, great. Grace?
So all investors have ADHD, right? We have very short attention span and very, very impatient. So I hate pitches where I have to wait for 40 seconds to get to what you're trying actually to build, right? So really get to the crux of the thing very early on, because we're not stupid, right? We want to dive further into certain areas, that would be the remaining part of the conversation. But don't let us wait for more than 15, 20 seconds before you say what you're actually building. And a few other no-nos of a deck. The deck is actually quite standard. If you want a template, we have it. It's a 10-slide thing, right? It's very, very standard. But it's a major turn off when someone comes and say, we have no competition. Right.
Oh, I have you on my notes.
Yeah, no competition.
Yeah,
no one.
one of the big no-nos.
No one thinks, no one has thought of this the way we have, or There's always competition. You're kidding yourself if you think there's no competition, right? So I think that is a major no, because it shows you don't understand the industry.
I agree with all the points, but it was always difficult being at the end here. So I would say that the two points I would add to that is so often people have like the team slide, and it's normally the slide they go over the fastest. They say, okay, yeah, I'm the CEO, he's the COO, and then we move on. And remember, we still invest in people. So you actually, and you don't just say, oh yeah, you work for Google, and you try and you actually spend a bit of time on the team slide, and you say, yeah, my co-founder, he worked for Kelku, he was the CTO there, he helped build a company, so he actually understands how to build teams, actually how to build a product, and that's why it's really good that we've got him on board. I've done this. Actually spend time explaining why you are the right team. Don't just think because there's a pretty picture up there and that you want to move on to the next slide. Spend time on that slide. And don't do it all the way at the end, because to be quite honest, we've already made our decision by then. So that's a slide which is wasted when we've all said that people are really important. I think the other point is when you're pitching, you're not pitching to entrepreneurs, you're pitching to investors. So what we want to know is not so much what you've done in the past, but what your future is. So many people go through and talk about their product and the problem they're solving. And they say, yeah, and we need $500,000 and last us 18 months. End. And I'm like, okay, but how are you going to spend that money? What are the key deliverables that you're going to do to make me, I understand your long-term vision, but I want to actually know what you're going to do with my money. And so I think on that point, don't get too focused on what you've done before you've actually got. To me, to be quite honest, don't really care. I want to see that you've done something, but I want to actually know more about the future. I'm investing in your future, not your past.
Cool. Perfect. Perfect, as always. So what are the biggest misconceptions that you come across when entrepreneurs come to you for fundraising? Like, are they, in terms of valuation or expectations, timing, alignment?
I think we'll do one each. I'll do the easy one. Timing. People really misunderstand that this is you've always got to give yourself 6 months to raise funds. Even if everything goes according to plan and super fast, it's going to take you at least 3 months really to close a deal from first conversation to actually getting the money in the bank. And that's if everything goes according to plan. I've explained kind of some of the reasons why that happens, but there's just a lot of paperwork and everything that actually needs to go through. So yeah, that's the easy one.
So I think one of the unrealistic stuff that I think entrepreneurs focus too much on is going into 5 years, 6 years projections. Because honestly, I think all of us know that if you can hit the 12 months projection, we'll be more than happy. We'll be celebrating like mad because we have invested in 40 companies. None of them have ever hit their 12 months or 24 months projection even. Some of them are just probably late by 36 months. I think when you go to too much of a projections and you think, okay, this is the projection 5 years from now, this is the P ratio of my comparables, and therefore, I'm able to exit at that value, and so on and so forth. You have to realize that 5 to 6 years time, the economic cycle could no longer be there. Your PE and PS ratios, it's just something plucking up from the sky right now, right? So focus more on really the next 12 to 24 months. This is what you're trying to do, because as even for early guys or for A guys, our money, even if we do invest in you, our money will run out in 18 to 24 months. I need to know what are the milestones that you're confident of achieving and whether will you survive the next 18 to 24 months.
Where will it get you?
Yeah, where will it get you? Otherwise, anything more than that, when you tell me a 5, 6 evaluation, I just don't bother. Because I know, at least in my experience, you are not going to hit that.
Yeah.
Can I just quickly add to that?
Quickly.
Very quickly. So one of the other things about forecasts is I actually do, I slightly disagree, I actually like seeing at least 3 years of the forecast, preferably sometimes 5, and it's not so much because I believe them, but so often I actually, again, want to see what your vision is. You come in and you're all going to tell me it's $1 billion opportunity. Boring. Because it's not what I want to know the addressable market, but what I want to know is if you're telling me it's this big opportunity, but in year 3 or year 5 you're doing like 5 or 10 million of revenue, I'm like, well, something's misaligned. You're solving this massive problem, and it's the really big opportunity, but you're only going to be doing a few million of revenue. As investors, we want to invest in high growth companies. We can accept that failure happens in some of the investments we make, but the ones that are successful, we need to be big. So, we need to see those numbers and see that and get an understanding of what your vision is. And what we do is we don't actually look at the numbers and say, oh, that's really interesting. We then actually go to the assumptions. We look at the assumptions that you've done. So you can't just throw out a big number there and say, okay, Michael said we want a big number. So I'm going to give him a big number.
It has to be defensible.
It has to be defensible. And what I think all of us, what we do is when we get your forecast, the first thing we do is go to the tab for the assumptions.
And then I think that one thing that, don't tell me, assuming we get only 1% of the whole market, that's just bullshit.
Oh yeah.
Why not 0.1%?
So funny.
Why not 0.01%? What makes you think you get 1%
Yeah.
of the market? And then therefore my revenue is such because, I don't know, top-down approach looks very nice, to evaluate, but some of the assumptions needs to be a bit more reasonable.
Grace, anything to add?
Yeah, one common misconception is, again, we are doing early stage, very early stage, right? Seed, pre-seed. A lot of the founders think that we are more interested in the solution rather than the problem, because it's easier to talk about the solution. It's the fun part. You brainstorm, you have sticky notes, you have focus groups, all that kind of thing. But if we were to split, if I were to put my weightage 80-20, I would say focus 80% of your time and your explanation on the problem, on understanding of the problem, not the solution, because like I said, the solution will change. Even after one meeting with any of us, it will change because you keep adding on the insights, right? So, we're in the same investment, he's on my investment committee too, and we get very frustrated when you paint this beautiful picture of your whole grand idea, and then when we ask, explain to us or describe to us that customer profile, right? And you're lost for words. There's no depth in your knowledge of who will actually pay for your product or your service. And you would think that everyone who wants to start a business would have spoken to customers, right? You would think that that's like the most primal thing to do.
Minimum they will do.
But so few actually do.
Yeah.
So few actually really talk to customers before thinking of the solution.
But get out of the building, right?
And so that's a very it's a very counter-intuitive thing, and doesn't make sense to an investor, and it doesn't make sense to the founder because you're going to now risk your professional and personal life solving something where you haven't talked to anyone about, right? So really for us, focus 80% on the problem, the description of the customer profile, the description of the depth of the problem, and then 20% on the solution. We will get the solution. Probably before you, we have already heard of 5 similar solutions.
Right, cool. So moving on, so valuation is always a very sensitive topic when you talk to startups when they're raising money. So what advice would you give to the founders? How they should approach the investors in such a way that not to lose their interest, but at the same time not giving up too much equity and dilute themselves too much?
Again, I think it's pretty standard. There are a few factors that will determine your price tag, basically. Factors such as, are you a first-time founder? Are you a repeat founder? Repeat founders, of course, get a premium price. because especially founders who have gone the full journey of starting and sold a company, right? Because you really have gone through that. For seed stage and pre-seed, very early stage, the valuation is floating at around $1 to $2 million. You know, if you're a first-time founder who come to us and say, oh, my company is $5 million, and then I'll call Michael and we'll have a good laugh. Right? That's what will happen. So there are a few things that are pretty standard. And then for Series A in Southeast Asia, it's a certain price range. You should do all this homework beforehand. If you're Series A in Silicon Valley, it's a different price. If you're Series A in China, it's a different price. So there are all these rules of thumbs, things that you can find out by coming to events like that. Yeah. Cool.
So I think for us, I would like to. I mean, the quick answer is valuation is really not a big issue for us. I mean, if you think about it, right, we are here for a 10x return. Whether you're valuing at 10 yourself, 10 million or 15, 12 million, 30 million right now, the difference only either be 9x or 10x, right, if you really hit that. For us, really, in terms of valuation, because you see, when we invest, before investment team, generally you've seen more or less similar business ideas. You know more or less what they are asking for. That's kind of, if you think of it, it's the relative valuation curve, right? No, you have a pretty standard mindset, but again, as what Grace said, you don't try to raise a Silicon Valley style Series A valuation in Southeast Asia because you will never hit that kind of valuation. And I think the idea is to spend time selling the team. I mean, if I like the person, I like the team. Do I really care? Is it 10 million posts or 15 million posts? I don't really think that matters too much. Again, that's for Series A, but earlier stage, there's some difficulty because.
Take note, very generous.
No, but because again, but it really depends on the cap table again, right? I mean, you don't want to value yourself too early because when the A guy comes in and says, I want to follow to more or less at least at 50% of the company, right? If you have valued yourself too early, you may not be able to achieve 50% post year.
I would say that there isn't a right way or wrong way. I mean, there's no scientific way that you can value a business, an early stage business, because there's no data points really to go off. I would say your expectation should be, you're going to be giving away between, on the whole, 20 or 30% of the business. And the difference between 20 and 30% is the experience of the management team, the problem, the size of the market opportunity that you're doing, and if you've got any traction, if you have that early traction, you do have that first customer or so. And they're all kind of, and also it's market demand. In some companies you hear them getting ridiculously high valuations, and that's because they managed to make an event out of fundraising. They didn't let it drag out, they actually went in there and what you've got to try and do is get a lot of interest at the same point in time. Because the minute that if a VC knows that somebody else is really interested in you and they could lose the deal, it means they actually have to make a decision. And they feel, okay, let's put in an offer that nobody else is going to want to match. If they feel that strongly about the deal, what happens a lot is entrepreneurs lets the funding kind of drag on, and they don't bring that excitement. They don't bring. So what you've got to do is you pick the kind of 10 investors that you really want that you've researched and thought they're going to be interested in my space. And the size of check size that I want. You then take the kind of, you rank them from 1 to 10. You then take 8, 9, 10, the ones that will be great, but you're not. Go and pitch to them. See what the questions are. People on the whole won't tell you why they reject you, but you'll know why they reject you from the questions. I don't focus on things that I'm happy with. I focus when I'm questioning companies and what I'm kind of concerned about. Also helps you refine your pitch. You then go to the ones that you're really excited. You practiced it, you know the questions, you might have made changes to your pitch, then you pitch on them. You see what the interest, and you try and do this all within a kind of 2 to 3 week period. You follow up with any questions. I'm amazed how many times I have a meeting, they pitch to me, I give them some feedback, ask them follow up, and yeah, I've got the mic. I've got your mic. So for me on that side, it's amazing that the follow-up afterwards. Try and keep the ball rolling.
And Rosita, just a quick one around the sensitivity of valuation, right? One, you might be covering this later, but one of the big no-nos that entrepreneurs should not do is to shop around. Okay, do not shop around. That's our sore point, which means to say you cannot say, hey Grace, we're raising this at $2 million, right? And then we might be, we may give a suggestion, and then you go to Michael and say, hey Michael, we have got some interest at whatever, and we're raising at 3 million, right? And then you go to him and say another price, trying to always fish for a higher price with every conversation. Guess what? We all talk amongst ourselves, right? There are only about 30, 40 of us in Singapore.
I think in some regions, there are no very super aggressive VCs like Silicon Valley. I see you on the cruise the next day, we talk, we look at the number of events, we see each other probably once a month at least, so once every 3 weeks.
We share intel.
Yes.
That's for sure. No, definitely. Leading on to that. So I've got 3 more questions and I'll open it to the floor. And I know I'm running out of time. So let's go to the crux, and you led us pretty smooth into this. So what are some of the things that you feel that the entrepreneurs are doing wrong to engage and secure the first meeting? This is after what you mentioned earlier was a few meetings have been secured, but just to engage with investors to secure the first meeting, what would you advise for them?
I wrote with my co-founder a blog about this, and one of the famous sayings that a lot of people say is that you should always be fundraising. And I think it's slightly misconceived I think you should always be looking for investors and building a relationship with them. The better they know you, the more likely they are to actually open your checkbook. So one of the tricks of the trade is, as well as doing research and getting somebody to refer you, if you can't do that, and especially with early investors, I think more than later stage, one of the best ways to actually approach an early stage investor is say, can I ask your advice on something? And then you pick that we're always looking for the next investment opportunity. But if you come and pitch to us, we're expecting gold standard, we're expecting you to be absolutely ready, and we're having to make a decision right then. If you come to us and say, look, I'm asking you for advice, we're expecting there to be holes in your pitch. We're expecting there to be issues. But we're always looking, if it's really of interest, we'll say, look, can you go and do this, and then come back to us in a month's time. And by that way, because my expectations are slightly lower, I build, and then you will have conversations, and you send me weekly or quarterly, monthly updates. So when you actually do say, actually, Michael, I'm ready now to actually talk to you about raising funds, I've probably actually already made my mind up. A, if I want to invest or not, but B, more importantly, I've already got to know you. So in terms, I can then accelerate, so we've got a situation now where we saw a company less than a month ago. We've already got a signed term sheet with them, and we're going to be closing them in a week and a half. So I told you, but that's because I've actually got to know the founders of the company 6 months ago. So by the time they actually asked me for the money, we're kind of ready to go. I'm sorry, there we go.
So what you're saying is also to engage early with the founders, right?
When you say always raising funding, you're always looking for investors and companies. You've already got a pitch ready. Go to a couple of VCs and just say, well, we're not raising funding, but we think you might be interested in this space, and actually see if they are, because they want to get to know you as well. It's the same process for them.
What you call no deal roadshow.
Yeah.
Another phrase is, if you want money, ask for advice.
Yeah.
That's true. Very good. So what advice do you have for startups to enable them to leave the investors with the first positive first impression? In order to keep the conversation going, in order for them to build the relationship that we talk about. Terence?
I think, at the end of the day, I think first meetings, is always a 50-50. You could catch the investor a bad day and so on and so forth. I've just heard this is the third pitch that something similar issues again today. I'll be less interested. But I think what happens was the first meeting, while it's important, I think personally, I think it's overrated. The fact is that you need to follow up with subsequent meetings. You show the fact that, by the way, these are the questions you asked me during the meetings. I've thought about that. These are the problems I'm solving. In fact, we already have something in place. there's a plan down the road, there's version 2.0 coming out in the next 2-3 months, right? I think it gives investors, hey, actually this guy, just listen to me as well. He's coachable. He's not going to brush me off. I think it's the subsequent following up, or at least this guy, as what Michael said, he's saying that this urgent, we need to raise funds in the next 1 month, and then 2 weeks later you don't even contact me, and then that if that's the way you're going to do business with someone who's going to give you a lifeline, then how would I expect you to do that to your customers who's going to be really the ones that are funding your future business, right? So I think the follow-up meeting is very important. You need to show that you listen. You need to show that you have taken all this into consideration. Because honestly, sometimes even if you don't have to try to be a know-it-all in the first session, right? If I ask you a question, if you genuinely haven't thought about that, just admit that and say, I will go back and think and get back to you, rather than trying to come up with something on the spot, because we will see that.
Yeah, very good. Grace?
Yeah, very quickly. I mean, just like in a friendship or a date or whatever, right? You know if it's a good conversation. You know that when you leave after 1 hour, you know that wow, I've learned so much from that entrepreneur. There's that listening, chatting, exchanging part that went on, and you look forward to the next meeting. And one way to show that you have listened and that you have taken notes and stuff is to send a summary email, right? To say, hey, thanks for the meeting today, we've learned a lot. These are the things that we said we will follow up on, ABC. This is the timeline, or this is the deadline. I expect to hear back from me on blah, blah, blah. And because, we meet, 5, 6, 10 companies in a day, right? So our capacity to hold, all the action items and follow-ups for each one is quite
Limited.
possible. Yeah, very limited, right? So you are leading this thing, and so it helps a lot if you summarize, send back that email, so that we keep a record as well. Make it easy for us to help you.
Yeah, that makes sense. Michael, last thing to add?
I don't really have much to add, except, one thing is when you're in a meeting, actually, you get a lot of feedback. Remember to take, you're going to get a lot of feedback, and you're probably doing a lot of meetings in the day. But it amazes me how people sit there and say, that's really interesting, and take no note of it. So how do you, it's really difficult to remember everything that is fed back to you. And it kind of gives the impression that you're just nodding your head and saying yes to everything to make me feel happy and feel special. If you actually write it down and then do what they say and actually follow up and answer any queries. I did an interview yesterday for an intern, and the guy just fluffed it. Absolutely fluffed it. I think just got rattled. But actually what he did afterwards is, there was a she. She actually followed up with an email and said, I realised I really didn't answer your questions properly. Here are, that this is what I really wanted to say. I really apologise for that. And I actually thought, well, that's great. A, she realised she fluffed it, and she didn't try and run away from it.
She recovered.
She recovered, and then she actually gave me really, really good answers. So I'm actually interested in talking to her again to make sure that it was her who answered and not somebody else. Maybe I'm a cynic. But at least I want to see her again and actually just check that out, because we all have bad days.
Yeah. Okay, so my last question, just to wrap up now, Grace, to you. What are your top 3 no-nos for the startup they should avoid at all costs when talking to investors? And what are your top 3 tips that you would advise startups to do when they decide to fundraise?
I think I kind of gave a lot already.
Yeah. Just to kind of summarize and to wrap this up.
Very demanding one.
Okay, do one.
Do one each.
Yeah, okay, thank you.
This is a tough crowd.
Yeah. So the big no-no is like, if you don't come prepared, you don't know your topic, you don't know the people, you don't know who you're talking with.
Do your research, get
Come
your value
prepared.
proposition out early.
Come prepared. If not, don't have the meeting that day. Right? It's okay. You have many more chances.
Yeah.
Then the tip is
Yes.
really for us, like I said, really focus on the problem and really be that authentic person that you are. Don't try to be someone else. Don't try to be another person you read on Tech in Asia or
Nice. No, totally. Yeah. Terrence?
So please just share your secret sauce. We are VCs. We at the end of the day, the team is the one that execute. Even if you tell us the secret sauce, we may not be executing. I've done one founder interview. After 2 hours, he refused to tell us what's his secret sauce. He said he's doing something different, but if you need to do anything else, we need to sign NDA and so on and so forth. I mean, that guy was very old school. He took it wasn't a PowerPoint presentation, it was a file with all the notes, a memo and all that. It was very, it was very elderly guy, just trying to start up something, but he says, these are what I've learned from my experience, but I can't share with you, If you come to pitch, you need to be able to share with whatever you need to share. I think that is, so if you say there is some secret sauce you cannot share, rest assured we are, I guess, professionals. At the end of the day, even if you tell us something that's very different, we are not in the business of executing the business. You are. So just don't be afraid to share.
Yeah. Michael?
I would say probably a big no-no is to waffle at the beginning. I think Grace said it at the beginning. We've got attention spans now about 90 seconds. I mean, if you've all hired somebody, and to be quite honest, within the first 90 seconds, 50% of the candidates that you actually hire, you've already dismissed. That first impression really counts. So when you actually come in to pitch, what you've got to do is really nail it right at the beginning. And the three things I always say you need to get across is the problem, the market opportunity, and why you. If you can get those across, then you've got the rest of it to actually demonstrate it. So you've just got to really demonstrate in that, and it's your elevator pitch. That's really what you've got to get right. Because I always say, if you can't explain the problem that you're solving within 1 or 2 sentences, then it's too complicated. You don't actually know what it is. Okay. In terms of a good thing that you can do, it's really difficult because it's all about I guess the people making that first impression count. But I think for me, it's showing during that meeting how prepared you are and making that investor feel that this is not just yet another pitch for funding. That you can actually, even on your first slide, pitch the Cocoon Capital. That you actually personalize it. Actually, that you can say, look, Michael, I know you've invested in Nugget. We're in a similar space, so you should know it. Again, the point was Terence made earlier, don't need to tell me about the space anymore. I know it. Yeah. Move on. Shows you
even if simply you open your folder, you put Cocoon Capital presentation. It gives you. It could be the same presentation, just change it. But it's a bit showing that you.
We like to feel special, right? Yeah, very good. Just also for me, just a side note, I get lots of founders when I speak to them and pitch to me. Guys, before you start talking to people, take a minute or two, right? I mean, it's really a big turnout, and I know this is really lame and small, but it's a huge turnout. Personal space, that's another thing. In some culture, it is acceptable to go right up front and personal within like 6 inches of someone's face. Not with me. I need my space. I wouldn't be, listening to you at that rate. I would just be backing off, right? So it's little nuances like that. Be very mindful. Be very aware. Your body language. Don't slouch. Be energetic. It helps so much. It just elevates your pitch so much more. With that, I will open it to the floor.
Any questions?
Please name what you do.
Yes. Name and what you do, and your question, please.
Hi, I'm Suzanne Hosner. I'm co-founder of Choice. It's a healthy recipe engine, whether you're eating out, having it delivered, or cooking at home. So my question is about the valuation. So you were referring to Southeast Asia, Valley valuations, and so on. So my question to you is, are those primarily, in your view, a factor of the markets that you're in? So are Singapore's based startup mostly valued based on being active perhaps in the region here? Or is that a question of being active in the markets here? Or is that just a factor of location and investor community willingness to invest here? So you can understand my question.
That's okay. I think you can all hear me. Everybody hear me at the back?
Okay.
All right, okay, fine. Literally, the core difference, not so much to do with the amount of equity that you give away, it's more to do with the amount of money that you have to raise. So in Silicon Valley, you have to raise, to do a startup and to get that first 18 months, you're talking about a few $1 million. And you'll still be giving away the 20, 30%. I'm excluding the really hot deals. I'm just saying, on average, this is where it is. In the UK, you're probably having to raise about £750,000. Over here, you could be looking at, depending on which country you're based in, but even in Singapore, around about the $500,000, $600,000 range. That, because you need to raise larger amounts, then your valuation goes up. People look at more at the percentage that you're giving away. So some of the later stage VCs will just come in and say, I want 20% of your business. So I'm talking on your behalf.
Yeah, I think that's really right. I mean, it depends on how much you're trying to raise. And then at the end of the A round, I want the team to stay at least 50-60%. Right? To do that, I need to see how much you raised previously and so on and so forth.
Yeah. And one of the big mistakes that especially early stage investors, early stage entrepreneurs make, is actually they're raising the wrong amount of money. A lot of people, if you haven't set up a business, there's always costs, and your assumptions are wrong. So actually a large part of what we have to do as an investor, we don't just take, you're saying you need 750,000, so we believe that. We'll look at your financials, we'll look at the assumptions, we'll go through that, and sometimes it can be a little bit less or a bit more, and then we'll start talking to you about valuation. But probably should have mentioned it earlier, one of the biggest mistakes is the amount that you're actually raising.
Okay.
Answer your question.
Yes. Next question.
Hi. Hello, Kevin Matthews here. Traditional business owner in the recruitment space and looking to develop another business in the HR tech space. Thank you guys for sharing your thoughts and insights. The question I would have for you guys is in terms of what is your competitive advantage as VCs or individuals with regards to helping entrepreneurs accelerate their business? So understanding from a personality trait or from a business philosophy perspective. And the second question is, what mistakes have you made in terms of deploying capital? And what were they particularly, how do you say, focused on? Yeah, thank you.
Very good question. So how we are all each unique and who we should speak with and why, right?
Yeah.
I can speak for Michael, but I'll speak to him on why he's unique. But for us, because I'm a founder and because the Hub is a co-working community of many founders, we are extremely empathetic on the founder and very, very founder friendly in that sense. So our trust and our relationship with the founder is really beyond that of an investor and founder. It's really very much, we don't mind the hand holding. So one of the main theses of our fund is that after we make an investment into you, you have to be in our ecosystem for 6 months. So that we can mentor, we can open up so we're pretty connected here and in Southeast Asia as well. So we do attract, for example, regional startups that want to start operating in Singapore. We would be a great partner because we can open up a lot of doors just like that, right? They're all in our phone books, right? So contacts, the intensity of the relationship with the founder, the amount of hand-holding, so those will be our differentiation.
I'm just going to say, in terms of the early set, and I'll let you parents get on. For me, I could say exactly the same. Every early stage investor will tell you exactly the same. Don't ever believe anything that you hear from us on that side, because to be quite honest, you can check.
Yeah.
Who you should go and talk to is you should find our portfolio companies and say, hey, look, Michael says he's an active supporter post-investment. He cares for the founders. He does this, X, Y, and Z. And they're like, we haven't talked to him since he invested. Or, yes, he has done this, he has done that. They're the people that you can believe. And don't talk to one or two. I put up there all the companies I invest in. You can see, you look at the track record and take it, do it on that way. They're the people you believe.
So just as we expect you to do research on us for this talk, similarly, you can do research on us with our portfolio companies, right? It makes sense to see whether what we say, we actually do what we say.
And actually, to that point, there are a couple of really branded VC funds here who don't do post-investment support. It's just not their method. It's just not their approach. Although they say they do, right, and things like that. So it's also we love it when you do a check on us because it shows you care who you partner with.
Shows you're professional.
Right.
And the question, sorry, the question you had, the second question in terms of the mistake I made is actually it just come to bite me in the ass today. I became arrogant, and I thought there was a couple of entrepreneurs that I really liked the problem. They were very good, but they were amazingly difficult, and I would say they'd moved from confidence into arrogance. I believe that I could change them. And as Grace said, you can't really change somebody. And as I said, it's now come and bitten me in the backside, because you can't change somebody. Nobody's that good. You know.
Sorry, moving on. Next question.
Oh, sorry.
Sorry.
Okay, so I think when you talk about Series A and B, guys, sometimes we tend to hold less. I mean, we invest in you should know the space better than us. But what we do, at least in this part of the world, is I think we are one of the few global VCs here. We have office in Shanghai, we have office in San Diego. We have office in San Diego, we have office in Shanghai, we have office in Singapore. I think one of our partners was an ex-physician of Malcolm Forbes, the Forbes family. One of our partners, our chairman is the guy that first invested Baidu in China. So we have all the connections everywhere in terms of fundraising effort and the right guys that to connect to you in certain governments, right? So I think that is where we don't come in and do operational stuff. That is because again it's A and B stage. We are way past that. We are trying to invest in you to solve a particular problem, right? We don't do the operational support. And I think in terms of when you talk about what the mistake that we made, I think for us, in the past we have not encouraged our company to go out there and spend. Sometimes say I want to raise a 5 million round, and they raise a 4 million round. The founders get scared. No, I don't want to spend as much as I could because my intended target wasn't there. I think on our end we should push them to expand. Just grow as though at 5 million, because we always have reserved at least 50-60% of follow-on investors. So we should have instilled that kind of just go ahead and try what you intend to try.
So last two questions, and then we'll be around to network. So yes.
So what meaningful commitments do each of you make to your co-founders besides money?
To the entrepreneurs? To the co-founders of the startups that we invest in?
To those you invest in, what commitments do you make to them besides money? What value do you add?
I think we kind of covered that. I mean, literally for me, as an early stage investor, every company is different. Quite often when we're investing, there's not a full management team in place. They're normally inexperienced. So it's really kind of difficult. Every company is, every kind of team is different. But quite often I work on the personal development a lot of the individuals themselves, because a lot of the times the founders have never actually built a business. They don't actually know all the ins and outs. They suddenly, all of a sudden, they go from being a developer to the CEO, and they're missing the skill set of actually being able to hold that position. So it's working with them to improve that. It's helping them with hiring and recruitment. A lot of them haven't really even done a forecast before. Some have, some haven't. So it's literally whatever is needed. What we've picked up during the due diligence stage, that's what we kind of do. And it's not always us. Sometimes we have people that we partner with that will actually give that support. So sometimes it can be, we've got somebody who does branding on a global scale. We persuaded him, or my co-founder did, to give actually like 10 hours free for portfolio companies to actually help them in terms of branding and building the brand. That kind of thing. So that's the kind of support, but it's not always from us, it's from the partners that we have.
I think we all touched a bit on what we could do, right? Opening our contacts, mentorship, blah, 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 and all that. But I think I would add also our commitment is to spot the things that you haven't spotted, that the entrepreneurs have not spotted, the blind spots, right? And to also help you prioritize, because especially for first-time founders, you're really jumping off the cliff and assembling the plane at the same time, right? Who's saying was that Reid Hoffman's saying. So there are 1,000 things to do as you embark on this journey. So our role is also to help the founders prioritize on what's important.
Yeah, so at least I think for our role we generally ask the founders, what do you What do you want? We know we need at this stage, they have more or less executed everything accordingly to plan. We need to ask them what is your vision, what's your goal, right? And we keep them sane, right? We ask them. Some founders when first invest, tell me, I want to sell my company for half a billion dollars and all that. Then when 100 million valuation, 100 million cash was put on the table, they started, okay, I think I should sell. Then I ask them, what is your goal? Your goal is half a billion. What has changed? Is it because there's more competition, you're not as confident, and so on and so on. So you need to ask them the questions because sometimes they see money on the table, your perception change completely.
Sure. Last question. And then again, okay, sorry, yes.
Hi, good evening. My name is Amanda. I'm from HAFTA. I'm familiar with Michael and Montida. We are trying to build the world's biggest repository of psychometric data. Now, this question is directed to Michael, but I'm welcoming Montida and Grace to chip in if you want to. There was a recent article that got released that only 1% of women founders decide to take VC money. And I remember doing a pitch to Michael, and you didn't give two hoots when I celebrated the fact that we had two gendered founding team, a guy and girl. Now, is there specifically a major lack or lack of talent of good women entrepreneurs in this region? And if there is, what kind of stuff can we do to make sure we stand out against the hundreds of male entrepreneurs that are coming out? That's it.
I'll tell you one second. That's what friends are for. Yeah.
Okay, this is a very, very, very big topic for me. And here's the interesting thing. As an entrepreneur, when I was just a founder, I didn't feel any discrimination or any sexism. Maybe because I just don't allow myself to listen to all this noise, right? And especially in Singapore, you don't really feel it. But once I got into venture, I completely feel it, the gender thing. Okay, so now in a year I would accept 100 public speaking thing, and I always say no to anything that has female something because I didn't believe that we're a gender that needed help, right? So the sentiment is like we have International Women's Day, but how come we don't have International Men's Day, right? Like there's this whole thing that this gender really needs a lot of attention, and I'm not okay with that. But here's the thing, there are two factors as to why there are very few VC-backed female founders. First factor is a pure demographic one, right? There are just fewer females who take computer science or who are engineers or who are starting up business. Just a pure demographic one. No one is to be blamed except for history and education systems all around the world. Okay. Second factor, and this is true, especially in Silicon Valley. I'm part of the Calvin Fellowship program right now, and it's everywhere. It's a central topic. There is a huge unconscious bias amongst investors, amongst venture capitalists. We want to always invest in things that look like us, or in people and companies who we think we have found a winning pattern. So the best VC funds in the world have shown us their portfolio CEOs company, right? Their company CEOs. Guess what? They all look like them. White male, 40-something-year-old, white hair, gray hair. They all look like them, right? So and the best and the best investors acknowledge this. They also acknowledge that hey, perhaps there is an unconscious bias going on, right? Can we fix unconscious bias overnight? Also cannot, right? So for women, maybe we use the unconscious bias to our advantage, right? I'm not hinting more than that, but perhaps that's one way, right? Perhaps also that we just need to be more aware of that, but there is no data or fact anywhere in the world that shows that women founders are a weaker breed. Okay, in fact, the opposite is true. There's a benchmark report on this. Something like if women co-founded companies have a 62% chance of being more successful than just men because we have special skills like empathy and compassion and listening, and all that kind of thing, right? So in fact, the data is going the other way around. It's just that the current system and those in power are not ready yet to change that thing. So whoever who feels like changing that, can do so. You don't have to wait for the people in power to change that.
I would say that the reason, just to be clear, the reason I said I don't care two hoots that you've got a female founder is because I don't really, for me, it doesn't make my decision one
You're an
difference.
entrepreneur, I don't care whether it's male or female or transgender, I
So,
really don't care.
if I give you some numbers, so for me, in the UK, I know the UK numbers better, only 5% of funded companies have got a female founder. Of my portfolio of over 20 companies there, just over 30% have a female-led team. Of my exits, over 50% of my exits came from had a female founder. So for me, I've actually probably got a bias towards, for many of the reasons that are being said. But to be quite honest, when I make an investment, it's purely based on the person or the team and the idea. I don't really have any biases that way, except in one. And I'll be honest with this, especially for a very early stage company. I'm not going to get sued, I hope, for this, but I am slightly ageist. So if you are kind of like 55, 60 and you're doing a startup, the amount of energy and drive and the focus that you've got to have is extremely difficult. Now, in certain industries, actually having a few grey hairs is actually a positive. But if you're building like a tech, high-growth tech business in new technology, I must admit it is something. I probably shouldn't admit that out in public, but you know, it is something you've got to be aware of sometimes. Is you've got to look at how much energy it takes to do a startup. I could never do another startup again. I'm way too.
So I've been asked before, so Montita, do you support female founders? Of course I do. So, how are you supporting them? I said, well, I would help them as much as I can, just like I would do to any other entrepreneurs. So to answer very bluntly, I do not show biases and favor female founders' startups. I would look at them as a business, whether it's investable or not. So having said that, we'll wrap this session up. And again, thank you all, and especially to all our panelists, Michael Blakey, Grace Tsai, and Terence Sim. Please give them a big round of applause.